Dow to 100,000, stocks to double. Did you hear that market bombshell? That astonishing prediction echoed across financial news wires. It came from a very familiar voice, a voice with a profound impact on the global stage. Just as quickly as the market plunged this week, shedding billions upon billions in value, this powerful figure emerged, not merely with a prediction, but with a direct, verbal intervention. It was like a hand reaching out to steady a ship listing precariously in rough seas. This pronouncement was so audacious, so definitive, it made you stop, scroll back, and listen again. Was it just a baseless rally cry? Was it another hyperbolic statement designed to whip up enthusiasm? Or was it, as some observed, a shrewd, strategic market intervention, one meticulously timed and expertly delivered? Perhaps it was a blueprint, a masterclass. It showed how savvy investors, the truly astute ones, should prepare for and navigate a politically charged market. This is where headlines can move more money than fundamentals. Think back just a few days ago. A palpable sense of unease had settled over trading floors and crept into investor sentiment. It was not just a slight tremor, it was a swift, jarring 2% plus drop across all major US indices. The S&P 500, that broad barometer of American enterprise, took a hit. The Nasdaq, home to our tech giants and innovation powerhouses, stumbled even harder. This was a classic risk-off scenario. It makes you double-check your portfolio and wonder if the good times were at last coming to an end. What were the immediate triggers for this sudden market anxiety? They were, as often happens in our interconnected world, rooted in politics and trade. Renewed fears of trade protectionism, that old ghost in the global economic machine, began to haunt the headlines once more. There were whispers, then louder pronouncements about new tariffs. Not just any tariffs, mind you, but discussions around potentially escalating trade barriers, perhaps revisiting old disputes or conjuring up new ones. Murmurs about Greenland-related trade disputes, for example, took on outsized economic significance. The threat of new tariffs, of erecting more walls between nations rather than building bridges, sent a chill through the markets. Businesses thrive on certainty and open commerce. Anything threatening that equilibrium makes investors very nervous. The technical charts, for those who scrutinize the squiggly lines and candlestick patterns, painted an even more concerning picture. The Nasdaq and the S&P 500 were not just falling, they were testing critical midterm support levels. Imagine a tightrope walker suddenly stumbling, their feet fumbling for the rope. These support levels are like that rope. They represent psychological and technical floorboards. If broken, they can trigger a much wider descent. They are the points where bulls traditionally step in to buy, believing the asset to be oversold. But when they are breached or even aggressively tested, it raises serious concerns. It points to a broader market correction, a more substantial and painful pullback, a potential breakdown in market sentiment that could take weeks, even months to repair. Investors, both institutional and retail, were on edge. The specter of a full-blown trade war loomed. It promised higher costs for businesses, reduced global demand, and an inevitable drag on corporate profits. No one wanted a repeat of previous trade spats that caused such volatility and uncertainty. The mood was somber, the outlook hazy. The question on everyone's mind was, how much further would we fall before something, anything, gave way? It was into this charged atmosphere of trepidation and uncertainty that the familiar voice made its audacious prediction. It changed the entire narrative in a single, powerful breath. This, my friends, is where the political playbook meets the market playbook. It creates a dynamic, savvy investors simply cannot ignore. We are talking about Mr. Trump's strategic market intervention, a tactic we have seen him deploy time and again, one that has, with surprising consistency, moved the needle. Consider his historical pattern. It is almost clockwork. When markets falter, when sentiment sours, and especially when significant indices begin trending downward with alarming velocity, he often intervenes. Not with subtle nudges, but with very direct, very public, pro market statements. Or, just as effectively, by signaling a reversal or de escalation of a controversial policy. Remember previous instances when trade tensions flared, or when some geopolitical crisis sent shivers through Wall Street? More often than not, a conciliatory tweet, a strong declaration of economic optimism, or a public softening of a hardline stance would follow, often within hours. The market would respond almost on cue. The recent rhetoric shift on tariffs is a prime example. One moment, we were staring down the barrel of new, potentially crippling trade barriers. Whispers of Greenland related disputes took center stage, suggesting a widening of trade grievances beyond the usual suspects. The next moment, almost as if a switch was flipped, the tone shifted. The threat of those Greenland related tariffs, for instance, seemed to evaporate, or at least recede into the background. Importantly, a signal emerged that there would be no military action. This was a crucial de escalation that immediately pulled back one of the market's most potent fear factors. This is no coincidence. It is calculated. This represents a very precise engagement with market psychology. But why the pivot? What drives this sudden, almost theatrical change in tone? The answer, as it so often is in politics, lies firmly with the political calendar. Midterm elections are not just approaching, they are, in political terms, breathing down our necks. For any incumbent administration, particularly one that has often staked its reputation on economic performance and a booming stock market, a crashing stock market is nothing short of political arsenic. It is toxic. It undermines voter confidence. It provides ammunition for opponents. It can rapidly erode goodwill built on prior economic successes. No politician, especially one who prides himself on being a champion of prosperity, wants to face the electorate with their financial scoreboard in the red. He needs to avoid a repeat of past market shocks. Those abrupt, stomach churning dips leave everyday investors feeling poorer and more insecure. Maintaining voter confidence, especially among those who closely watch their retirement accounts, is paramount. It was not just about tariffs, it went beyond merely de escalating a trade spat. He explicitly talked up the market, not with a cautious forecast, but with a bold, almost unbelievable prediction. The Dow, he declared, would hit 50,000 soon, and eventually 100,000. Stocks, he asserted, would double. This is not the language of a cautious economist. It is the language of a master persuader. It is a direct attempt to buoy sentiment, to inject a massive dose of optimism directly into the veins of the market. It is a psychological operation designed to shift the narrative from fear to exuberance, from caution to conviction. This brings us to what many in the financial world have unofficially dubbed the Trump bump phenomenon. It is a very real dynamic. It is inextricably linked to an unofficial market adage that has gained considerable traction over the past few years. While the venerable maxim, "don't fight the Fed," has long guided investors, advising them against betting against the powerful policy tools of the Federal Reserve, a new, equally potent piece of wisdom has emerged. Don't fight Trump when it comes to market sentiment during his political tenure. This is not about blind loyalty or political endorsement. It is about recognizing a consistent pattern of influence. When he speaks, especially on economic matters, the market listens, and often it moves. His motivation, when viewed through a pragmatic political lens, is crystal clear. Market performance, particularly the health of the stock market, is often, perhaps unfairly, inextricably tied to perceived economic success. For the average voter, a rising stock market signals prosperity, job growth, and a healthier economy overall. Conversely, a falling market signals trouble, recession, and instability. This perception is absolutely crucial for political campaigns and, more broadly, for maintaining voter perception of competence and effective leadership. A president, any president, understands that their reelection prospects or the prospects of their party in midterm elections are heavily influenced by the economic mood of the nation. Therefore, actively managing, or at least attempting to influence that mood through strategic pronouncements becomes a vital tool in their political arsenal. He has shown an unparalleled willingness to leverage the presidential bully pulpit to affect market psychology. This makes it a critical factor for any investor to consider. Now, let us zoom out a bit. Let us dive deeper into the market dynamics surrounding midterm elections. This particular point holds a counterintuitive yet incredibly powerful piece of data for the astute investor. Historical market data often suggests, somewhat surprisingly, that markets tend to perform better under a divided government. Think about that for a moment. Instead of a single party holding complete sway over the White House, the House of Representatives, and the Senate, a divided government means that control is split. You might have one party controlling the presidency, while the opposing party controls one or both chambers of Congress. What is the rationale behind this seemingly paradoxical market behavior? It boils down to predictability and stability. A divided government, by its very nature, tends to prevent extreme policy swings from either party. If one party controls everything, there is a greater likelihood of them pushing through their most ambitious and sometimes most radical legislative agendas. For example, a fully Democrat controlled government might aggressively pursue extensive new regulations on corporations, or enact massive social spending programs funded by significant tax increases. Conversely, a fully Republican controlled government might push for drastic deregulation or introduce deep cuts to social programs, along with sweeping tax reductions that could balloon the national debt. While these policies might align with the ideological preferences of their respective bases, from a corporate planning and profitability perspective, they introduce enormous uncertainty and potential disruption. Companies, big and small, thrive on a stable, predictable operating environment. They need to forecast costs, anticipate regulatory burdens, and plan for future investments with a reasonable degree of confidence. Extreme policy shifts, regardless of their political intent, make this incredibly difficult. They create a climate of what if that can stifle investment, delay hiring, and ultimately weigh on earnings. A divided government, however, acts as a natural check and balance. It forces compromise, moderation, and often legislative gridlock. While this can be frustrating for voters hoping for swift action on pressing issues, it is often a boon for the markets. It means that neither party can fully implement their most extreme proposals. Excessive regulation from Democrats is tempered by Republican opposition. Uncontrolled spending from Republicans is reined in by Democratic resistance. The result is a more stable, more predictable environment for corporate planning and profitability. Businesses know that radical changes are less likely. This allows them to focus on long term growth strategies rather than reacting to every legislative whim. This critical data point, this understanding of how markets react to political control, is incredibly important. It informs our long term outlook. It helps us to anticipate market behavior, not just leading up to November's elections, but also in the aftermath, regardless of the outcome. It provides a strategic lens through which to view the political landscape and its financial implications. Now, let us bring this back to the present moment, to the volatility that gripped the market just days ago, and to how a sophisticated, disciplined investor approaches such situations. While Mr. Trump's comments, with their audacious predictions and de escalation of tariff fears, certainly offered some immediate relief, like a sudden drop in a fever, the technical charts tell a more nuanced story. They show that the S&P 500 and the Nasdaq, despite the recent bounce, are still very much approaching critical resistance levels. Imagine a runner who has just sprinted uphill, catching their breath. They might feel better, but they still have another steep incline ahead. These resistance levels are like those inclines. They represent price points where selling pressure historically tends to emerge. This potentially caps further gains. The path forward is not guaranteed. It is a battleground, not a victory lap. This, my friends, is precisely why this is emphatically not a time for panic selling into dips. Nor is it a moment to chase rallies based on a single headline, no matter how powerful the source. Those are the emotional, reactive behaviors that characterize the majority of market participants, the ones who consistently underperform. Instead, sophisticated investors, the true contrarians, view such quote unquote price distortions and heightened volatility as gifts, as opportunities. When the VIX index, the market's so called fear gauge, spikes by 26% or more, as it did, it is not a sign to flee. It is a siren call. It means fear is rampant. Prices are being indiscriminately driven down. Rational thought has often been temporarily abandoned. This is where the contrarian investor's playbook shines. They see these periods of extreme volatility as prime opportunities for strategic accumulation or for intelligent portfolio rebalancing. Instead of being swept up in the collective anxiety, they ask, what quality assets are now on sale because of irrational fear? Where can I deploy my capital to buy more of what I want at a discount? Their focus remains steadfastly on long-term value. They divorce themselves from the short-term noise and headline-driven hysteria that consumes the less disciplined. They understand that these moments of market overreaction, fueled by political rhetoric or sudden fear, are the very moments when genuine opportunities are created. Opportunities for those with the foresight and the discipline to act. They are not fighting the market, they are exploiting its temporary irrationality. Now, let us consider the immediate aftermath of this politically charged market intervention. Let us look at the near-term market outlook. The good news, if you will, is that the immediate crisis, particularly the heightened tariff fears that sent shivers through the market, may indeed be temporarily diffused. Think of it as an adrenaline shot, momentarily stabilizing a patient. The potential for institutional selling, such as the specter of massive EU bond divestment, which was a very real concern for some, also seems to have receded into the background, at least for now. However, and this is a crucial however, the market still needs to confirm breakouts above key resistance levels. These are technical battle lines. If the S&P 500 and the Nasdaq can decisively clear these ceilings, it signals a strong shift in momentum and a potential move higher. But if these levels act as stubborn resistance, if prices bounce off them and turn lower, then the risk of a renewed downturn, a retest of those earlier lows, or even a deeper correction remains very much alive. This reprieve could simply be a dead cat bounce if the underlying technicals do not support further upside. And we must not forget the lingering rhetoric. Even as the immediate tariff threats receded, we heard statements such as not giving up on Greenland or remembering opposing nations. This suggests that the long-term geopolitical friction, the undercurrents of international competition, and potential trade disputes have not vanished. They are merely simmering beneath the surface. they are waiting for another opportunity to resurface. These comments act as potential future market quote unquote fear factors. They are reminders that political instability and trade tensions can, and likely will, reemerge to influence market sentiment. So, while we may have bought ourselves some time, the inherent volatility driven by political grandstanding and geopolitical maneuvering is not going away. It has simply moved to the back burner for now. This brings us to the strategic positioning for the disciplined investor, the kind of investor who understands that these moments are not about panic, but about precision. The smart money approach is precisely about avoiding emotional, reactive decisions. It means not falling into the trap of selling into a perceived market bottom, only to regret it later for missing a swift rebound that always seems to catch the majority off guard. And just as importantly, it means not chasing a rally with blind euphoria, only to see it reverse and leave you holding the bag as the less disciplined often do. These are common behavioral biases that consistently erode wealth. Instead, the smart money understands the importance of leveraging quote unquote dry powder. This refers to maintaining a portion of your portfolio in highly liquid assets. These could be cash reserves, strategic bond allocations, or even within larger entities like pension funds if that applies to your investment structure. The purpose of this dry powder is not to sit idle and earn minimal returns indefinitely. Its purpose is to be strategically deployed during these puddle moments of market overreaction. When fear is rampant and quality assets are temporarily mispriced. When the market plunges 2% or the VIX spikes 26%, that is not a signal to retreat. It is a signal to evaluate, to rebalance, and to potentially buy more of your best ideas at a discount. It allows for calculated rebalancing, buying low when others are selling in a panic, and capitalizing on temporary mispricings that the emotional majority creates. Think about the high cost of impulsivity. Frequent trading driven by fear or greed rarely, if ever, outperforms a disciplined long term approach. Consider the friction costs, transaction costs, brokerage fees, and perhaps most importantly, the drag of capital gains taxes on short term profits. These costs, seemingly small individually, accumulate rapidly. They erode returns and make it incredibly difficult to compound wealth over time. The evidence is overwhelming. The most successful investors are often those who do the least in terms of frequent trading. They allow their quality assets to compound over decades. They weather the inevitable political noise and market volatility with stoic patience. Now, let us take a brief detour into the fascinating world of cryptocurrency, specifically focusing on Ethereum, or ETH. Despite the broader market's recent bounce and the temporary relief from macro fears, Ethereum's technical picture still requires careful observation. On the weekly chart, it is currently testing a crucial multi-year uptrend support line. Imagine a strong, upward sloping trend line that has supported price action for years. Ethereum is right there, kissing that line. This is a pivotal moment. The key focus for investors watching Ethereum will be whether it firmly holds this support or, crucially, whether it breaks decisively below it. A break below such a significant long-term trend line could signal a much deeper correction. Furthermore, even with the recent rebound, ETH still sits below critical resistance levels. This means it still has significant ground to cover to confirm a new leg up. While a long-term bullish outlook on ETH remains for many, given its foundational role in decentralized finance and Web3, prudent risk management is absolutely essential, especially given its notoriously high volatility profile. This is not a set it and forget it asset. It demands active monitoring and a clear understanding of its technical battlegrounds. Finally, let us confront the hard truth of wealth building in any market, but especially in one so influenced by political whims and headline noise. Market opportunities and challenges are universal. Every investor, regardless of their background or net worth, faces the same economic data, the same political events, and the same market movements. But individual choices and individual strategies dictate disparate outcomes. This is where the 1 in 1,000 concept comes into stark relief. The vast majority of people, quite simply, fail to achieve significant financial success. This is because they lack the discipline, the patience, and the long-term perspective needed to weather volatility and exploit opportunities. They get swept up in the fear, they chase the hype, and allow emotion to dictate their decisions. The journey to financial independence, to a point where your capital income eventually surpasses your labor income, is not a smooth, linear ascent. It demands time, resilience, and the ability to endure long periods of, quote, no progress or even painful setbacks. These are the moments that truly test an investor's resolve. The market will always try to shake you out, to force you to sell your good assets at bad prices. It will always present new fears, new uncertainties, and new reasons to doubt your long-term plan. But it is precisely in these moments, when others are giving up, that the truly successful investors maintain their conviction. They stick to their strategy and ultimately reap the rewards that accrue to the patient and the disciplined. This is not just about market cycles, it is about human psychology and the triumph of foresight over fear. So let us bring it all together. We have just witnessed a powerful, politically motivated market intervention, a stark reminder of the critical, often unpredictable link between politics and our portfolios. It underscores that in today's interconnected world, economic decisions are rarely made in a vacuum. They are not isolated from the political arena. The key takeaway for you, the savvy investor, is this. In a market increasingly driven by headlines, by political maneuvering, and by the emotional reactions of the masses, the truly successful investor remains disciplined. They understand the underlying market mechanics. They recognize political theater for what it is. And crucially, they prepare to capitalize on volatility rather than being consumed by it. They see temporary dips as opportunities, not as disasters. They ignore the noise and focus on the signal. My final encouragement to you is to embrace this long-term strategic mindset. Make the conscious choice to become part of that extreme minority, that select group who use market noise and political events not as reasons to panic, but as levers to their advantage, steadily building wealth through holding good assets and allowing the power of time and compounding to work its magic. Remember the words, however audacious, however politically charged, that kicked off this discussion. Dow to 100,000, stocks to double. Whether those specific targets are ever hit is secondary to the strategic approach they inspire. It is about positioning yourself to benefit from the long-term upward trajectory of quality assets regardless of the short-term political storms.